Hi students, in this video we are going to see a past exam question on acquisitions, mergers and acquisitions, specifically how to find premium, the maximum premium that can be paid for an acquisition. Kind of a repeated topic that is tested, the premium or the price to be paid, maximum price to be paid. Let me just give you a brief idea as to how we calculate the premium. First, understand we will have the acquirer, then we will have the target company, the target. You acquire, then you have the combined company. Right. So what we do, we first find V1, the equity value of acquirer. What method we are going to use depends on the information given in the question. There might be cash flow valuation details could be given, PE valuation could be given, or dividend valuation information could be there. Read the question and find out. There will be some information to use one of those methods and find the equity value of acquirer. Do the same thing for target. Sometimes different methods, acquirer, they might give the PE information. Target company, they might give you dividend valuation information. Something else could be there. Whatever the information available, use them and find the equity value. Then the combined company, find the equity value of this. Right. So there are two types of questions they can ask. One is this, maximum premium. They might say, for this acquisition, what is the maximum premium you can pay? So in that case, you are going to answer V3 minus V1 and V2. That means at the individual values, V1, V2, subtract that from V3. That is what you call the maximum premium. Another term for that, value created by the acquisition. Right. This is maximum premium. Sometimes they ask what could be the maximum price for this acquisition, maximum price. That's very simple. Find the combined company's value, subtract the acquirer's value. The difference is what you call maximum price. Here we say premium, here we say price. So in summary, without going into the details why we are doing so and all, in summary, this is the calculation steps that we are going to do. Make sure you complete these calculations. Don't leave the questions halfway. When you complete it, even with couple of mistakes, if you complete it, you get majority of marks based on your steps. Right. Now let's go to the question that I wanted to discuss is this. Vogel Company. We'll take few minutes. Read this. If you have the book, you can read it yourself. If not, stop the video time to time and you read it yourself and then continue to see the calculations. Vogel Company, a listed engineering company, manufactures large-scale plant and machinery for industrial companies. Until 10 years ago, Vogel Company pursued a strategy of organic growth. Since then, it has followed an aggressive policy of acquiring smaller engineering companies, which it feels have developed new technologies and methods, which could be used in its manufacturing process. However, it is estimated that only between 30% and 40% of the acquisitions made in the last 10 years have successfully increased the company's shareholder value. So that's the introduction paragraph. We will have a look at the requirement and come back. Discuss the possible actions Vogel Company could take to reduce the risk that the acquisition of Tory company fails to increase shareholder value. This is also one routine question they ask: why acquisitions fail, how we can avoid it. That's one area they often ask. Second one, estimate showing all relevant calculations the maximum premium Vogel company could pay to acquire Tory company, explaining the approach taken and any assumptions made. 14 marks. Professional marks, 5 marks. Right. So a lot of information. At this point, please stop the video, read it yourself, and come back to the calculations. I'm skipping that here so that I can save the time of reading the question. Okay, but I'll summarize this for you. What is given in the question? It's like this. We have Vogel company, that is the acquirer. Then we have Tory company. Tory company has 3 divisions: A, B, C. There are 3 divisions. Manufacturing and selling 3 different stuff, 3 different components. So what Vogel is planning to do, they want to take over this whole company, Tory, and then their plan is this. After the acquisition, Vogel and Department A of Tory will be the combined firm. This is the company that they want to run, combined. Right. This Department B of Tory, they are going to spin it off. That means they are going to separate this department as a company. They are going to register this as a company and they are going to sell that company. So this is going to be a different company. Department B, they have a name for that, Dutch company. So that's going to be a different company. Right. And what about C? Department C, what they are going to do? Department C, they are going to strip off the assets. They are going to take the assets and sell the assets only. C, assets will be sold. C, assets will be sold. Look at this again. This is the acquirer. Let me change the color. Right, acquirer. I will be finding its value V1, equity value. Tory company. Initially, it's just one company. The target company is one company. It has 3 divisions in it. ABC, 3 divisions. So all those divisions together, I will find the value of the company V2, value of the equity. Combined company. What is combined company? Vogel plus this Department A. Only this one is going to be combined with Vogel, which is V3. Department B is going to be separated. They call it spinning it off. They spin off B into a separate company, and there must be some valuation information. Let's use that and find V4. C, assets are going to be sold. So let's find how much you're going to get from those asset sales, V5. And as usual, if max premium is the requirement, I'm focusing on part B of the requirement now. If premium is the requirement, V3, V4, V5. Let's add all of them together. Look, all this. In my previous example, the general example I explained, I just said combined company. That's all here. But this time, it's not just combined company. The business combination creates a combined company and a couple of other entities as well. So all of them are post-acquisition values, V3, V4, V5. From that, you're going to subtract V1 plus V2. So I need to find information to do the valuation of each of them one by one. Find V1, find V2, find V3, find V4, find V5. Finally, substitute into this formula. Alright, so that's going to be the action plan. Let's start. So now let's go to a new page. Right. Vogel company. Let me find the values of Vogel company. Vogel company, the information given, I will show you where it is given. Pretty straightforward, they say. Vogel company's current share price is $3. Simple. Where do you find the number of shares? Number of shares. Here, share capital 190. So, value of equity. How do I do it? 190 divided by 0.5 is the number of shares. 190 is the equity value, book value. Per share it's 0.5. Divided, you get the number of shares multiplied by $3. This is the value of equity. This is what we mark as V1. In my diagram, I marked it as V1. Very simple, it's finished. Go to the next one, Tory Company. Tory Company, the information says here, Tory Company's PE ratio is 25% higher than Vogel Company's PE ratio. So I need to find Vogel's PE ratio now. So I got the value of equity. You know, PE ratio, how do we find it? Either you can do on a per share basis, market price per share divided by earnings per share. If not, you can do it all together. What is all together? Total value of equity divided by total earnings. So I have total value of equity here. Let me find total earnings. This is of Vogel itself. Total earnings, I remember the statement was given. Pre-tax profit is given 158.2. Pre-tax profit. Okay. So equal 158.2. Come on. Equal 158.2 multiplied by 1 minus tax. How much is the tax rate? Both companies pay here, tax rate applicable to all the companies is 20%. 20%. So 1 minus 20%. What am I doing? Pre-tax profit I am converting to post-tax. That will give me the PE ratio of Vogel Company. How? Price divided by earnings. Almost 9.001. That's the PE ratio. So now Tory Company's PE ratio, how it is going to be? It says 25% higher than Vogel's PE ratio. Can you see here this sentence? So 25% higher. This value 25% higher means I can multiply by 125%. That is Tory Company's PE ratio. Done. Do we know Tory's earnings? Yes, statement was given. There you go, 23 pre-tax. So equal 23 multiplied by 1 minus 20%. 18.4 earnings. So value of equity is going to be earnings multiplied by PE ratio. Earnings multiplied by PE gives you the value of equity. This is what V2. See how simplifies the question now. V1 is done. V2 is done. Now I am going to do V3, V4, V5. This is why the planning is so important when you are starting the answer. Action plan. What I am going to do here. That is very important. Once you finish reading it, reading the data, make the action plan. Then step by step, like part by part how you are going to do it. Now, Vogel plus Division A combined firm. What information is there for valuation of them? Is it PE ratio? Is it something else? Let's see. Here, same point, it says, after the acquisition, when Department A, when Department A becomes part of Vogel Company, it is estimated that Vogel's PE ratio will increase by 15%. They are talking about PE ratio. So again, it's going to be earnings-based valuation. Alright, let's find the PE ratio. First, 15% higher than Vogel. Okay. PE, PE, Vogel's PE is this, 15% higher, 15% higher. 10.36 is going to be the PE ratio. Then let's find the earnings. Earnings, Vogel plus Department A, right? So Vogel's earnings will be included. Tory, I need to find out whatever the division A's earnings will be included. And there could be some synergy benefits. Synergy is a separately testable question. You know that synergy means when two companies get together, they make more profit than the sum of their individual profits. Why? There are three areas of synergy: revenue synergy, cost synergy, financial synergy. We will discuss that later in a different area. So I need to find the earnings. The point is this: I need to find Vogel's earnings, Tory's division A's earnings, plus any synergy is there. Okay, one by one. We'll do it here. Okay, earnings. Let's take one by one. Vogel, Tory, division A, synergy. Let's add all of them together. Vogel's earnings, I already have it. This is Vogel's earnings. Tory's division A earning, I have the Tory's total earning. This is Tory's total, A, B, C all together. Division A, how much? A table is there here. Department A, share of profit is 50%. 50% profit is from division A. So earnings multiplied by 50%. There you go. That's Tory division A earning. Synergy benefits were given in the last point. It is estimated that combined companies' annual after-tax earnings will increase by 7 million due to the synergy benefits. So synergy benefits 7 after tax. So total earnings, this plus this plus this. I got the total earnings. I got the PE ratio, value of equity. Earnings multiplied by PE ratio, 1478. Clear? This is what I marked as V3. So 3 valuations are based on PE itself. So simple. Very simple. Now the fourth one. What is fourth one? This one. Dutch company. There you go. It is estimated that, look at this point, Dutch company's cost of capital is estimated to be 10%. It is estimated that in the first year of operation, Dutch company's free cash flows to firm will grow by 20%. Did you notice this point? Free cash flow to firm. Let me quickly recap this knowledge on free cash flow to firm and free cash flow to equity if you have forgotten. Cash flow valuation. There are two: free cash flow to firm valuation, free cash flow to equity valuation. Different cash flows. I'll explain now what each of them are. This one, you must discount at weighted average cost of capital. This will give you, once you discount the free cash flow to firm using weighted average cost of capital, what you get is value of firm. Value of firm means VE plus VD, value of equity and value of debt you will get. Whereas if you take this approach, free cash flow to equity approach, you have to discount those cash flows using KE. Once you use KE and discount it, what you get is straight away value of equity. Now a question arises, what is FCFF, what is FCFE? You take PBIT, profit before interest and tax. Then find the tax on PBIT. See, not with the interest impact, without the interest impact. Then add back the non-cash items, like add back depreciation, amortization, subtract investments, You may have two types of investment: maintenance investment, expansion investment. Maintenance investment means investment to maintain the capacity itself, replacing some of the assets, improving some of the assets just to maintain the capacity. Expansion means expanding, yes. All those investments, subtract them. Then what you get is free cash flow to firm. So if you see here, interest is not included, loan payments are not included. I said investments, but not the loan payments. So this cash flow is for whom? Who is entitled for this cash flow? Both equity holders and debt holders, because this is the cash flow before servicing the debt providers. I repeat, before servicing the debt providers also. So you can't take this cash flow and give it to your equity holders. No, you have this is for equity holders as well as debt holders. That's why we say free cash flow to firm, and that's why we use both KE KD together, WACC, to discount this. From this, if you subtract the interest payments, interest net of tax, net interest, let's say, subtract the net interest, any loan repayments you have, subtract it, then you get the answer. That is free cash flow to equity. This one, fully it's entitled to equity shareholders because you have subtracted all the interest payments also. Debt servicing cost have been calculated or captured. Right. So this is the summary. Going back to the question, they are talking about free cash flow to firm. Cool. No problem. Let's see how we can do it. So they say there is going to be some growth. First year it grows by 20% and then it grows by 5.2% annually thereafter. So the statement given to us is the last year's one. For year ended 30th April 2024 means the latest year. Okay, no problem. Department B. So what I'm going to do, the plan is if you read the question carefully, you will understand what they say here. This division current year, I'll find their cash flow FCFF 0, let's say. Then year 1 it increases by 20%. So I can find FCFF 1, first year cash flow. Thereafter year 2, year 3, on so on. Every year it increases by 5.2%. So you know, in dividend valuation model we studied a formula P0 equals D1 divided by KE minus G. Use the same model here. If you find this figure, first year cash flow, I can say current value P0 FCFF1, because I simply need the present value of all these after year 1 and after year 1. So take FCFF1, free cash flow to firm 1, divided by, instead of KE, you use WACC, because this is free cash flow to firm, minus cash flow growth. This is the plan. I need to find the first year free cash flow. How am I going to find first year free cash flow? I will find current free cash flow, increase that by 20%, first year free cash flow is ready. Then you apply this formula, you will get the current value of equity. So I am now attempting to find value 4. Dutch company is the name they have given. That's basically division B for department B. I need to find the cash flow. So let's say current year. What is given to us? There you go, 49. Right. PB, pre-tax profit is given 23. This is for the company. From department B, they say 40%. Share of PBDIT and pre-tax profit 40%. So what we will do, I need profit before interest and tax, right? So we will take this figure, PBDIT, subtract depreciation. Why I say that? There is a point about depreciation also. Where is that? Here, tax rate applicable. Dutch company can claim 10% tax allowable depreciation on its non-current assets. Since they have given the depreciation information, let's find share of PBDIT, profit before depreciation, interest and tax. From this 37.4, I have to take it. Okay. So let's say share of PBDIT 37.4 into 40%. Department B accounts for 40%. 37.4 into 40%. Then I need to take tax allowable depreciation. What do they say? 10% of assets value. Assets are 40%. Share of current and non-current assets 40%. So non-current assets 98.2. With a minus, let's put it 98.2. 40% is Department B's assets. On those assets, you get 10% depreciation. Look, 40% is to find the assets, non-current assets for this company. Then 10%, not 1%, 10% to find the depreciation, because they say 10% is the depreciation. Okay. Then you can take PBIT, profit before interest and tax. Then the tax on it. PBIT. This multiplied by 20%. That's a tax on PBIT. Now, what did I explain here? Tax on PBIT. Then you add back the depreciation and subtract the investment. Okay. So you add back the depreciation. Again, tax allowable depreciation. Let's add it back. What you already subtracted, let's add it. The minus, if I put it, will become plus. Okay. Added. Investment. There was a point about investment. I'll tell you what. Here. It can be assumed that the amount of tax allowable depreciation is the same as the investment needed to maintain. So maintenance investment and depreciation are same. There is no expansion investment they are talking about. Maintenance investment is going to be same as this depreciation amount. So minus this figure itself. Since these two are equal, it will nullify each other. It will cancel each other. Depreciation has to be added back. Why are we adding back? That's a non-cash item. You are finding cash flow, so you have to add back the depreciation. And why are we subtracting investment? Of course, you are finding cash flow. You need to subtract investment. Investment is a cash outflow. Right. But most of the cases, they say these two are equal. So if you look at the workings of many books or even the suggested answers, they would not write these two. They would have completely skipped these two lines. The whole reason is that is equal. Anyway, free cash flow to firm that we get here is, let me say, sum function, sum of PBIT, subtract the tax, add back the depreciation, subtract the investment. That is the free cash flow to firm that we get. 8.83. Let's go back and see here. Oh, I missed this point. Look at this point. At present, around 10% of Department B's profit comes from sales made to Department C. So there is some sales between the divisions, Department B and Department C, but you are planning to close down Department C. Remember, you are stripping off the assets of Department C. So what will happen from Department B to Department C, whatever the revenue, whatever the profit that you were getting is not going to be there. I need to subtract that also before finding tax basically. So this 10% has to be subtracted. So where I will subtract it, share of PBDIT, I found 40%, right? We will subtract 10%. So can I multiply by 90%? Because 10% of that profit is no more. Why is it no more? Because that was the sales to Division C. Division C is going to be closed. There you go. That is what the share of PBDIT is going to be. Then depreciation is same. No change with that. From there we got PBIT, tax, free cash flow to firm. Good. This is what? Current year. Remember, this is FCFF 0. This is FCFF 0. I need year 1 FCFF. Year 1. What do they say about year 1? This will grow by 20%, 120%. That is the year 1 FCFF. Let me mark it as FCFF 1. Then what formula I gave you? P0 equals, again let me write it here, FCFF1 divided by WACC minus G. From year 1 onwards, it must be the constant growth, then you can apply. So let's apply this formula. Value of equity. This is the FCFF divided by WACC. WACC was 10% here. Cost of capital is estimated to be 10%. Minus growth rate 5.2. 5.2. Annually 5.2. If you have not read the question, it will be confusing. Make sure you have read the question thoroughly before you see the answer. If you don't have the question, please drop a comment. I will send you the question as well. Value of equity is this. This is what, go back and see the diagram. This is what we marked as V4, value of this company. Step by step, V1, V2, V3 done, V4 done, now V5. What is V5? The sales proceeds from division C or department C. You are selling the assets of department C. There you go. It is estimated that for department C, the realizable value of non-current assets is 100% of their book value. Good. So 20% is the assets from department C. Look here, non-current assets of overall Tory is 98.2. 20% is from department C. 98.2 into, so non-current assets 98.2 into 20%. This is the non-current assets book value. You get the same value when you are selling. They say 100% realizable. Good. Current asset. What do they say about current assets? Current assets realizable value is only 90% of their book value. Okay. 46.5 is the company's current assets. 20% is from department C. 46.5 into 20%. This is department C's current assets. When you sell them, you get only 90%. Right. So that's what you get from the assets total. So let me get the total gross proceeds. What do you do with these proceeds? What are you going to do with these proceeds? Here, the cost related to closing department C are estimated to be 3 million. So closing down cost. There is 3 million for you, minus 3. Let's subtract it. What else do we have to do? Funds raised from the disposal of department C will be used to pay off Tory company's other non-current and current liabilities. Other non-current and current liabilities. Tory company has 20.2. They are going to settle that fully. They are going to settle that fully, not 20% or anything. 20% is only for assets. So the entire liability, other non-current and current liability 20.2 is going to be settled. Subtract other liabilities minus 20. That's all mentioned. We missed this point. What is this point? You know, Dutch company, we did the free cash flow to firm valuation. So this 190.72 is not value of equity. What is this? This is value of equity plus value of debt. So that's not V4. So what will be the value of equity? Remember I explained where if you use FCFF method, what you get is VE plus VD. Value of equity and value of debt. I need only value of equity now. How do I get that? From this value, subtract the value of debt. That is what they say. 7% unsecured bond will be taken over by Dutch company. Which means this 40 is going to be reflected in Dutch company's balance sheet. So this is the value of debt for them, 40. Subtract that 40. There you go, that is V4. Good, at least now I noticed that. Right here, so this is the total proceeds from the sale of assets. You have some closing down costs of 3 million. Other liabilities are going to be settled 20 million. Net proceeds. $5.01. So let me mark down the values one by one. V5, this is V5. 5. V4. This one. V3, V1. V1 was there at the beginning. Here, value of equity, V1. V2. V3. There you go here. Okay. Remember the premium formula I gave you? Maximum premium that can be paid. How do we get that? You add these three, V3, V4, V5, post acquisition values, add all of them and subtract whatever you had initially, V1 plus V2. $287 millions, I remember. Was it dollar millions? Yes, dollar millions. This is the maximum premium that can be paid. How many marks is that? 14 marks. 14 marks. Let's see, estimate showing all relevant calculations. The maximum premium Vogel company could pay to acquire Tory company, explaining the approach taken and any assumptions made. Okay, you will have to explain few assumptions there. So assumptions like the estimates are reliable, this 5.2% growth is sustainable throughout like forever, and then tax rates will be constant, cost of capital will be constant, so such, and synergy values are reliable. When they have calculated cost of capital, they have factored all the relevant information. So those are the assumptions you have to write, the general assumptions, nothing much here. So that is what, or that is how you find the maximum premium that can be paid in an acquisition. This question is a little complicated than an average question because you had all this. You know, after the business combination, it's not just one entity, you have multiple. However, the valuation was not that complicated. V1, V2, V3 were straightforward PE based valuations. V4 was the only one, you know, you had to be a little bit careful. Still, I wouldn't call it difficult, but you have to be careful. V5 is asset strip-offs. That's very easy. I skipped part A. Part A is about why acquisitions fail and how you can avoid it. Discuss the possible actions Vogel company could take to reduce the risk that the acquisition of Tory. So how can you avoid it? Like in the background information they have mentioned, many of their acquisitions have failed. So they want to know how they can ensure that the failure doesn't occur. But let me explain one by one. First one, sometimes the information you get to do the valuation, because you are acquiring a private company, it's not publicly available information. So whatever submitted by the management is the information you have. Make sure you do a due diligence to find out whether all those information are accurate, whether the assumptions based on which you do the valuation are valid, whether the assumptions are sustainable assumptions, right? So information need to be thoroughly analyzed so that we ensure we don't do a mistake. Of course, the selling companies, the target companies management would like to show a higher value for their company, so that they can deliver better value for their shareholders. Acquirers must be very careful about it. Vogel company have to be careful about it. First one, information. Second one, the shareholders have to ensure whether the acquisition is really a value adding one or not. Meaning, sometimes there can be suboptimal decisions. Suboptimal decision means managers for their own benefits they make decisions. Very, very basic kind of example I can give you. Some CEOs or some management, they like to have a bigger company. They believe that is an advantage for them personally. They believe that is a good brand name for their company. So they keep expanding, they keep acquiring. But if you look at the financials, whether the acquisition is really worthy to the shareholders, it may not be. So we need to have mechanisms to ensure proper corporate governance practices, proper committees to approve such acquisitions, to evaluate such acquisitions whether they are really value adding to the shareholders, right? So suboptimal decisions or dysfunctional decisions, we say, such decisions should be avoided. Third one, integration issues, a very common one. Integration issues means post acquisition, the two companies' staff are going to work together. There was one question, even I remember in AFM there was one question, they say one company is an autocratic company. It was about some book publishers, I remember, e-content publishers, book publisher. So like the acquirer is used to very autocratic style, very systematic way of doing things. Whereas the target company, they are recent startup, but very quickly they have grown up. The reason for their grown up was fast decisions and casual decisions. Over the coffee, they discuss and make decisions. That was their style, informal structure. Now, when they all are going to work together, how will it be? If you don't take effort to manage this integration, one party is going to be unhappy. Most of the times, it is the target company's employees. They feel, they are deprived from the way that how they have been working. So special efforts must be taken, special teams can be appointed to ensure the integration is smooth. There are no friction, there are no issues arising in the integration process. Fourth one, synergy. We included some synergy. Thorough analysis has to be done whether the synergy is realizable or not, because if you have miscalculated synergy, if it is overvalued, you might end up paying a high premium. Later, after the acquisition, you feel like, oh, this is not worthy this much. We have paid this much. We thought there will be this much of synergy. We expected, but we actually don't get all that now. These are all errors in your calculations, being optimistic. So we should avoid all that. So synergy benefits must be thoroughly analyzed whether they are actually achievable or not. See, these are some of the common points you can write as to how acquisitions, how you can avoid failing in an acquisition, right? Most of these points, pre-acquisition, like this is pre-acquisition, this is pre-acquisition, this is pre-acquisition, this is post-acquisition. There is something called, when I say post-acquisition only, I remember there is something called post-acquisition audit. Meaning, right after the acquisition, do an audit to see whether your assumptions were right, whether the latest forecast after the acquisition, after the business combination, whether the new forecasts are in line with what you expected. Why? If not, if anything is going wrong, if anything is going different, you can take corrective actions faster, isn't it? So these are some methods to avoid failing in an acquisition. You don't have to write all of them. 3 or 4 good points. If you explain, 6 marks should be simple. Clear? Right, so that's one nice question. I finished it in approximately 45 minutes with all the explanation, but I didn't give you the time to read. I read the question before you. So 25 marks, uh, 45, 50, 55 minutes maximum when you are practicing you can take to read and answer the question. Clear? 3 hours is your exam. 3 hours means 180 minutes. 25 marks means 1/4 of that. That's actually 45 minutes you can take. I took more time to explain. I went to different areas, explained all that. It took some time. Yes. So keep practicing. AFM is a subject you can pass well only if you practice really well. Make sure you keep practicing. And if you have any specific questions that you want me to answer, please comment on under these videos mentioning the question name. I will take those questions in my next videos. Thank you and all the best.